and we'll kind of officially start the meeting. It depends a lot on the type of trader you are. Oh, let me share the screen here. It depends a lot on the type of trader you're going to be. You're not going to do better if you're a breakout trader and then you're still in the ES. You're not going to do better. You're going to definitely do worse, and if you're lucky, you're going to do the same. If your style is for the markets to break out, you're in the wrong market when there's a lack of volatility in the ES. It's just that simple. So you're going to have to start navigating and looking for markets that move more to adhere to the style that you're trying to implement. Okay? If you like playing ranges and you're a patient guy, that's probably those that answered better or the same, because it's range bound. It's generally consolidating more than it's breaking out, right? If it's not breaking out a lot, it's consolidating. So you have to know, is your style adhering to the fact that there's a lack of volatility, or is it absolutely opposite? That's number one. Number two, are you having trouble with small winners and big losers? Two things happen when we get to extremes. Number one, if we get to a high volatile extreme where it's really volatile, people will have that imbalance in their P&L, where they're going to have bigger losers, and people who don't know how to trade, I should say. I shouldn't say all people. People who struggle with their trading, and then they try to jump in the waters of high volatility, they'll have small winners and big losers because they can't trade that extreme, and they can't adjust and adapt. Then the other extreme that we're kind of in now, these low volume, low volatile environments, same imbalance. You finally get a winner after waiting, and it's just going your way a little bit, you just take it. You start to get impatient first with your winners, so you cut them short, then you become patient, lackadaisical, complacent with your losers, and you just let them go. So again, that extreme with high volatility or low volatility create the imbalance of small winners and bigger losers. The other thing you have to attach is your personal volume to that of the market you're trading. If your personal volume is up and the market you're trading is down 30%, you're probably not having much to show for it. If you're lucky, you're probably breaking even minus commission right around zero. That's if you're lucky. The more the market trades, the more you trade. Even if you don't like volatility, there's just more things happening and more setting up for across all time frames when markets are moving and are volatile. When they're slow, everything takes longer to develop. There's less setup setting up. Therefore, you should have less trades and volume. So you have to attach your average volume to that of the market. That has to make sense to you. I mean, if there's more volume traded in the market, it's because people who trade are trading more, and vice versa. So if you're trading a lot in a slow market, you probably don't have much to show for it. And you got to adjust to the volumes and volatility. Like I said in the room, I think today volatility and volumes are essentially the same thing. Low volatile environments, low volume environments, period. When you hit big ranges, you get big volume. You get big volatility, you get huge volumes. You get no volatility, you get no volumes, period. Low volumes, below average volumes overnight, regular trading session. We're running below 1 million almost every day here in the S&P. Take a look at this chart. Just look at the volume across the top here. It's barely 400,000 today, 778 yesterday, 900, 920, 800. Got above 1 million on this session, but it's below 1 million. You haven't seen that many sessions below 1 million stacked up like that in a long time, especially in the month of October, which is historically the busiest month from a volatility standpoint during the course of a year. Not so much this time around. Now, I want people to be patient because there is always volatility around the corner. Went into a period like this in 2005, and the guys that adjusted did really well in finding markets that fit their style. There was always markets moving back in the mid of last decade, 05, 06. So when I transition to markets like gold and oil, markets that you're trading aren't moving or fitting your style, you're not stubborn to just stay in it. Secondly, and I remember the owner of the prop firm saying this, is that this is the time you really hone in on your skills. You really hone in on one thing, discipline. If you can't be disciplined in slow markets, you're not going to be disciplined in fast markets. But if you can be disciplined in slow markets, you really created and polished up on a tremendous skill set for when markets pick up. And when markets, the whole idea of volatility is just more movement. Everything moves just a little bit faster. There's just more prices that trade. Why? More volume, more people stuck. The more we're going to break out, the more we're going to move. Less people stuck, less people have to exit, less we're going to move. Period. So you can't trade a volatile market the same as you trade a low, kind of slow market. So it keeps circling me back to looking at other markets. If you join the trading room every day, you notice I talk a lot more about the NASDAQ and crude oil because I want people to really look at some of the opportunity in crude, not just because it moves more than the ES, but it doesn't move as fast as oil used to, which made it a very expensive market to trade. It's always been $10 a tick, but the liquidity has jumped, which made it a little bit more of a safer market. When I say safer market, it was tough to trade it small because the smallest you could trade this market is with one contract. Well, your risk was pretty high even with one contract in a market that moved a lot. Now it's a little more liquid. More liquid becomes a little safer and easier to get out of your trades or your losers. Now, a trade that I really like in here, and people following it and being consistent are liking, is when old support turns to resistance, old resistance turns to support. But you got to be consistent with it. You got to know when you're missing the trades and when you're taking the trades. Because you get yourself caught into a situation where you're missing your winners and catching the losers, that's a problem. Because that's going to lead to just some events trades and you're going to get outside your setup. And it boils down to lack of consistency or lack of review or lack of real-time understanding. So crude oil right here, just I want to give you a sense of when it didn't work. It comes into support in here, gets through it, leaves some resistance behind in those two red lines. Does it stop and rotate down? No, it doesn't. Now, I don't know if there was a story that drove us fast in here because it looked like it went fast in this area right there. I'm not saying that would have kept you out of a loser. This would have been a loser, most likely. Now, this is a 6 PNF. We're going to drill down in a 2 or 3 PNF just to see more real time what it looked like. The point is that if you're taking this trade and you take this and it's a loser, it's going to you're supposed to take it. But you hope to be on this team in here to catch this move, old support, new resistance, and it comes off. Maybe you caught it, maybe you didn't. Big thing about crude oil, and you guys know from being in the room today, was this move that I personally missed. I mean, I caught the news event up in here, but didn't hit it, didn't put 2 and 2 together as quick as I normally do, as quick as some other people did in the room. And I'm not on top of oil as much as bigger oil traders than me are. But right in here was that story that was unwound, and the story was the unrest in northern Iraq was creating some supply issues or potential supply shock. That's what gave oil a bid the last session or so. And then a little resolution with the Kurds saying they'll adhere to the original borders. Wham, that supply shock story went away. So did prices. No worry about supply. Prices generally in a very supply demand driven market like oil is go lower. They did. This is probably the best move of any market all session long. It broke over 50 cents. Good move in oil. So that's just a little bit of crude oil. If you're doing nothing, sitting on your hands, not interested in the ES board, there are other markets. Trading is trading. Obviously, there's nuances in different markets and different fundamental factors and geopolitical events that affect different markets different ways. The concepts and the techniques are very common. Now, I like to get into a 1, 2, 3. We did a couple weeks ago with Peter. I've asked Dave just to open his mind. I want to keep something and things very, very simple, because when you're in the flow, when you're trading consistent and you're making money, I want people to be consistently bad more than inconsistently good. You've heard me say that before. If you're inconsistently good, that's very frustrating. If you're consistently bad, we at least could eliminate some things. I could work with you. But if your consistency in and of itself is a skill that most people don't have. Because it takes what? Discipline. In order to be consistent, you have to be disciplined. And most people lack that. So you got to be disciplined and just do what you say you're going to do when it's set. When your setup sets up, you're there to recognize it A, to trade it B. And to know when you miss it C. Well, let me open up David's mic. Dave, are you ready? Just to talk here? All right. All right, Dave. Hello again.
Good morning again.
So let's pretend I never met you. And I'm asking you, what is it you like to do in the NASDAQ? And I'm a fifth grader, by the way. So talk to me like I'm a fifth grader, maybe junior high. Give me that. So I'm in junior high and I'm trying to figure out what you're doing, but I'm looking at my charts right now. Are you looking at my charts also?
I am.
So explain to me what you're trying to do on the chart that you're looking at.
So the one that, before I even get to this, I'm looking at a 150 seconds, the 2.5 minute chart of price delta, three panes, price delta, and relative volume. And so the first thing I'm looking at is where's the relative volume for the day versus the average of the last 20 days. And so we started out this morning, I forget, I told you what it was. I think it's minus 25, minus 30. We're low. And so that in and of itself tells me, unless something changes radically, that this is a fade day, not a trend day. So,
all right. Okay. I understand.
A couple of things. So that's a big step one, which means the volume's coming down.
Let me interrupt you. How often are you looking at through just at the beginning of the day? You kind of get a sense it's above or below average?
Constantly.
Constantly. Okay.
Yeah. So we're watching. So we got the day. There's two sets of volume. There's the day average, and what that is the volume to this minute in the day compared to the volume to this minute on average over the last 20 days. So
moving average like of 20 days.
Yeah.
Got it.
So minus 37%, which is where we are now, says we're 37% below the amount of volume that's come out at 11:24 a.m. for the last 20 days.
I like it. Okay.
And then there's a second set of volume, which is doing the same thing, except it's a 15-minute look back. So now so that responds faster. It's all in the same pane. So the where we are in the day and how that's changing is setting is it a trend or is it not a trender? Clearly not a trender today. And then the 15-minute look is telling me how the market's reacting to price. So like when we came down to early in the day, we came down into the 9 range, and we got there and volume just fell off a cliff. I'm watching the 15-minute average, and it is just falling off a cliff, which told me we're done going down for a while. The bad news is, just as I clicked, it launched on us like 5 ticks and never came back. So while the analysis was accurate, it doesn't matter because I didn't get paid.
Well, let me ask
that's what I was looking at.
Explain the difference between the 15-minute and the 1 minute for relative volume again.
So I don't have a 1 minute relative volume. I got a 15-minute, and then I've got the day to this point.
Oh, that's what I meant. Okay. So what's the difference?
So one's more reactive than the other. If you're looking at a 15-minute average, of course, you're more reactive to change. And so the day volume, the day to this point, that sets a tone. And then, so if it's low, that sets the we're not trending tone. But then the 15-minute shows me how the players are reacting to price levels. So when we get to a price level and volume dries up, well, we're probably done for a while on a non-trend day, and so.
It's the same concept though. It's comparing back 15-minute chunks from the last 20 days.
Yep. And so, and the way I put it is, you can't hide traded volume. No. There's lots of games you can play in the dome. There's stuff you can do, making Delta do different things based on if a big player trades it a certain way, but you just can't hide traded volume.
Like my intelligence, just can't hide it. I try.
I just can't
do it. All right.
And so that's a bunch of the context right there. And then on the same chart is, now that we've set up and said, okay, it's a fade day. Well, part of the fade picture is looking for big pluses or minuses in delta. If you see a big chunk of negative delta come out and we've come into a price level, it's time to start looking at some more detail. So the other context, so we really just started on, that's just the first step. And then there's another bit of the context, which is still probably step 1, is looking at a daily profile and seeing where we are in the daily profile versus yesterday. And there's a 15-minute bar chart on top of it. And so you're looking at how price is moving. I have weeklies and monthlies up as well that I look at, but in this sort of a non-trending market, I mean, the weeklies and monthlies aren't that interesting. It's all the dailies because of the limited price movement.
So
that's all the context.
Daily volume profile.
Yep. Full day. So it's the full Globex session is what I'm looking at.
So relative volume, where are we at relative to the last 20 days? And do I see a spike or a pullback in volume when it navigates into a new price area?
Right.
And it could be a new price area for this session, like when it went down to 0509. Finally broke out. So it's when it finally makes a move and gets into a new area. It's almost like if the volume falls off, it's like the market's looking around in that new area saying, I don't want to stay here. And it goes back up.
Yep, that's right. The participants are done. So that's essentially a kind of you can think of it as rejection. They don't want to play anymore at that price.
Yeah, no, I like that. They don't want to play anymore. Well, because the old adage is, did it rally on good volume or no? If you think of stocks, if a stock rallied on good volume, there's some validity to the strength. And
for me, this solved a problem that I'd had for a long time, and that was trying to decide, was it a trend, or was it going to trend, or was it a fader? Because if you pick wrong, you're just going to get your face ripped off.
Yeah.
And so this has solved that problem for me. And the answer can change during the day. A couple of days, maybe it was late last week, we actually got above zero volume coming into the open. And I thought, okay, good, we're going to trend finally. And we got a little bit of what looked like might be a trend, and then the volume fell right back out, and it turned into a fader again. Well, I knew it immediately. You quit. If you try to play a breakout in a non-breakout market, it's just painful.
Yeah.
You're just going to be nothing but frustrated.
Right. You're gonna lose, and then miss the winner if it doesn't break out. That's all it always happens.
Right. And during the day we were talking about, I brought to your attention the spot for the head fake. So I love the head fake entry, and that's the perfect fade entry. So when we came down to 09, and I was looking for it to shoot down a little lower because there's a nice volume area from 9 down to 6. Well, so we get into that thing, we shoot a bunch of volume into it, and it gets absorbed. Well, I don't remember where I bought it down there, but it was in the low 7s somewhere when it traded down into that, because it did. It's a fade market, and it shot down into it tripped a bunch of stops and shot down into a big volume area from yesterday.
05. That's what I see here. It was around 940.
Yep, that sounds about right.
And that's interesting. So you had a big negative delta, but you're not buying it in that bar necessarily. I mean, you're not buying it. Where did you say you got long in the 7s?
Yeah, I'm looking for it somewhere around 7, 7-ish.
So what I like about that is you already see some breadcrumbs of evidence. You come into support, you had nice red delta, and at that point it can't break. And then the first time we kind of take out some red was in here and leave some green was in here. And I think I remember talking about it right in here this morning that they were probably now poised to take out these 3 reds because they had already held it in here. So you had that context also. They were ready to, take out what was working well back here and here and here and here to take it out. Pretty much the first red followed by some green in here. Now you do have it in here, don't get me wrong. But you have it here a couple times and then it just takes off. So you're looking at some red delta, but it doesn't follow through. And the overall volume fell off on that 15-minute chart, correct?
Let me see. It didn't do much. It wandered around a little bit. There wasn't a really big reaction in the 15-minute, in the 15-minute volume average. So nothing really out of that.
But if it spiked, would you be less likely to fade it and buy it in this area? If volume spiked?
Yes. If it was growing a bunch of volume as it was getting closer to that, then yeah, I'd be more concerned about taking the long out of there.
See, this is great because in order to find value to something, you got to compare it to something else. So he's comparing volume to a moving average that's relevant, not just something that's, all right, we got more volume than yesterday and it's just a one-time check. He's constantly checking back on volume in this particular time frame. Let me just get this correct. It's 15 minutes and it's checking back that 15-minute period over the last 20 days?
Correct.
That bracket almost.
Correct. So right now we'd be looking at from here to back to 11:18. I'm in Central Time, so 11:33 back to 11:18, and it's comparing it against the volume that happened in that 15-minute period for the last 20 trading days.
Yeah.
And by the way, we really suck. We're minus 78% right now.
Wow, it really fell off.
Yeah, and it's been for the last before 11 o'clock. It's been below 50% consistently since 11, right around 11 o'clock.
What I like about that is it not only gives you a sense of comparing it to something so it's percentage wise up or down, but it's like time sensitive too. It strips out. Well, of course, volume is down. It's middle of the day. Well, it's comparing middle of the day data. So you're
That's right.
apples to
And it's
apples.
very easy. It's very easy for me to say I'm not going to touch this. I mean, it's normally you'd be sitting and before I came up with this and started watching it, I would be thinking, well, all right, are we going to have a breakout? Are we going to do? And I'm looking at this going, it's not going to do a thing. I mean, something needs to change. We just shot a big bunch of sell delta out. So if I was going to do anything, it'd be looking to buy it, but there's so little volume that, I mean, the chances of this, even though it's a reasonable setup from a looking at the delta perspective, it could just sit here and drift around. So this is a keep me out of the market and keep me out of the way thing too, and it's doing it right now. I don't want to touch this.
I looked at the book. Jim just said it too. There's a 300 lot, 299 officially bid from 11, 2 points lower, 11 even for 299. I don't know if he's been there for a while, but they traded 11's. They traded 11 quarter right above it here, and they're hovering, maybe looking to take it out.
Yeah, so 11 is the edge of a consolidation. There's one on each side. So when we were down lower into the fives and sixes, it's the top of that consolidation, and it's the bottom of the most recent consolidation. So it's a great place for a fight.
So as a junior high student here, the one thing I learned, mister, was volume is really important relative to previous days' volumes in that particular part of the day for you to either play or not play, to fade
Right.
or not fade.
Right.
If you've seen volumes, let's go back in here. If you've seen volume, the market finally had a move and dipped down into some virgin territory, 05 to 10. And in this area, you did not see volume go up or down. It was pretty straight or sideways from like 920 to 945 when it was between 9 and 05 and 010. Make sense? Is that true? Is that fair to say?
I'm sorry, say that again. I didn't understand what you were saying.
From what time was this? 9:20 Central to about 9:45 Central. What was your relative volume doing?
Let's see. Let me look at where we were there. 920. Actually, there were some pretty interesting big negative delta pushes there that said it's time to look for a long. There was one in the 2.5 minute period that ended at 925, another one at 930, two more at 942. Yeah, there was some interesting stuff there. And so they keep pushing all that negative delta, and they're not going anywhere.
And you know that as you come across a couple bars right in this area.
That's right.
My screen you're looking at. So it's almost like all this red here has to turn to green, and that's what's going to give you the pop. Here's what's important with this setup. If you played it early and said a lot of negative delta couldn't go lower, well, it kind of did. A lot of negative delta couldn't go lower, well, it kind of did. A lot of negative delta couldn't go lower, kind of did. Plus, this was just the first couple rotations to good resistance, up around 11 even, from this push lower. So you get, this is why this is like on the other side of it, where I made, for different reasons, came up with an idea that the NASDAQ are going to take these out.
And I'm looking at something else that you're not looking at. I've got a 1 second chart that once we get into that sort of area, then I'm watching it at that level of detail where you're seeing the absorption. You see the big delta shot, you can see how large it is and how much is getting absorbed and where. And so that 1 second chart's got probably 2.5 minutes worth of data on it. But that's where the entry comes from. You see this all setting up and the big negative delta, but then you see the big shot hit on a 1 second chart, and they just get punched in the face and just stand and stare at them.
Do you feel like this, as you've molded this together, has given you, this is my setup? It might not work, but this is my setup. Okay.
It has. It's given me a couple of setups. I mean, but mostly it's looking at reaction, being able to see the reaction of the players when trade happens.
Well, my point is that a lot of people's weakness is they have a setup, but they're not sure if this is my setup. So therefore, they're not going to be sure to take it because of the risk, because there's always a chance a setup's not going to work. But it seems like, from listening to you, there's no ambiguity. This is your setup when you see it, and you're either going to take it or you're going to miss it. But here it is, right? It's stripped out the randomness.
Right. Once it goes away from it, I'm done. I'm not going to be chasing it.
Not going to be chasing.
I'm sorry, go ahead.
No, but you're not ever saying, this is kind of my setup. This is kind of what I'm looking at. Let me take a shot. It's pretty clear to you. I'm not trying to make it clear to everybody else. Sometimes that's hard. I'm saying for you, it's pretty clear.
Oh, it's very clear. And so the question when I get into it is and the reason when I saw the volume fade at 09, the first time we got down there, the reason I hesitated and missed the long is I was looking for it to break through 09 down, head fake down and come back up. And so I was waiting. I was looking for that. And about the time I figured out that the volume was going away and it wasn't going to happen and clicked, it was, 5 ticks away and done. And since my entire stop is 6, I'm sure not going to go chase it back up.
No, right.
Chase it up 5, even though it would have worked. I'm not going to do it.
No, because you're almost getting out for your profit, and now you're getting in, and it changes everything around. So
yeah, and that's the other thing with this. You had has the volatility helped you or not? Volatility, the lack of it is not helping me, and it's the reward to risk ratios are all screwed up. When we're moving, my reward to risk is 3.88 to 1. So you can make a lot of mistakes at 3.88 to 1 and still make money.
Where's it at
this
now?
environment? I'm sorry?
Where is it at now?
Theoretical best case 2.33 to 1. Reality, it's somewhere between 2 and 0.6, 0.7. I mean, it's so I had a whole string of one scale and outs. Well, so you figure that out. You got one scale and out. Well, that's an eight tick winner against if you had a loser, a 12 tick loser. So there's your 0.66. That ain't great odds.
No, right.
And so that's what's causing me. So right now I'm down just a little bit. I mean, not in any sort of significant. It's a noisy, not much, but I've had 17 trades. Well, guess what? The broker and the exchange are thrilled. I'm not so happy.
Right. And you've cut down on your size to kind of, because you mentioned that earlier, to kind of combat this.
Yeah, and it's all the reward to risk. So if you're doing thirds, and the last third is going to be plus 10 handles, and you look at this chart and see the chances of me getting plus 10 handles out of this are so close to 0 they can't be measured. So all that's doing is adding another third of a position on that'll get me stopped out when it makes my reward to risk even worse. So that's by shedding that top contract, and that's a decision I made. Come in this morning, it's minus 25%. Okay, we're trading halves, not thirds, and that helps. That preserves some of the reward to risk. Mm-hmm. But still, when you're looking at an 8 and a 20, and those are the loaded deals, and the chances of getting the 20 aren't very good either. Well, therein lies the problem. Therein lies the challenge. The reward to risk is not nearly as good. So, if I can stay alive in this environment, and I can, then, we get the price moving again. It ought to be a happy day.
You could kind of get a sense of price moving based on coming into into a session, and you're not down 25%. You're even or down 10%, right? But you're only looking
If it
back
was
15 days.
if it was close, yeah, then you start to, if it's close to zero, then I'm gonna go. I'll trade thirds and see what it does, especially around the open, and then you see what the volume does after that.
See, the other thing you got to remember is once you get into, you're only looking, what, 15 or 20 days back, right?
Right, 20.
So the volumes started dropping 30 days ago. So if you're running below average, you're running below average, right? I mean, it's like
Yeah, right.
really diminishing fast. So it's even more relevant as far as that goes. But you're just trying, and this is what I like about it, is it's easy to reference. There's not much thinking. It's like, okay, we moved in a new area. What's volume doing? All right, what do you mean what's volume doing? Compared to what? Well, compared to what volume did or was doing in this 15-minute time frame when? Just yesterday? No, over the last 20 sessions, which is a month, if you think
Yeah,
about it.
that's a month of trading. That's why I picked 20 was to get a whole month trading month in there.
But it's the last 20 days, right?
Correct.
Now, another thing that's interesting is, will you visually look at a consolidation box or will you have it from a profile?
Both. So
Okay.
I'll look at the recent consolidation. I can see that in a 150 delta chart. I can see it in a 4 PNF, but the larger ones, so that's where the recent ones show up. The larger consolidations show up in a profile.
And one of your trades is for it to leave and then come back in a larger profile consolidation.
Yeah, so like that deal, right, what you're showing on your screen right there, what I'd be looking for would be a shot down, have it sell a bunch, have a bunch of sell delta show up and go just slightly below that consolidation. You didn't get a head fake down out of that. You got close, but get a shot down and then buy it from there. Yeah, buy it from exactly. Have it shoot that. What time is that? Let's see.
10, roughly, Central. This is all around 10 o'clock Central.
Yeah, we didn't get any good shots there. And actually the volume had picked up and that had started to look like a potential trend at that point. So that would have been a great place to see a little bit of a shot. And there's not much of a shot in any of that. The biggest one is minus 120 contracts in 150 seconds. So yeah, they weren't selling that very hard at all.
Yeah, I'm looking at. You prefer, though, in this consolidation to get the head fake lower to buy it for a rally higher.
Yeah, and that came out of looking at performance. I mean, how many times did I have a stop right down there below that?
Yeah.
And then get taken out and as it goes higher, well, you look at that and it happens to you a few hundred times and you finally say to yourself, maybe I ought to do something different. Maybe I ought to be the market that's below that line instead of dumping to the market that's smarter than me and is below that line. So now I want to be the market below that line.
Playing the strength.
Yep, that's right.
Which is
and I miss them. I mean, that's a perfect case right there. It pushed down, but it didn't actually break, so I probably would have missed that. In fact, I think I did miss that because I was looking for a little bit of a push down, and it just never happened.
Where you get a little bit more stuck volume.
Mm-hmm. Right.
Stuck shorts to fuel this up.
Stuck shorts. Or stuck longs, stuck late longs. So I would have missed that, and that's okay. Because I didn't see what I wanted to see.
When would you say you started hitting your stride? Because you've always been, better, round zero better, but when you start hitting your stride, what was the key thing you added? Let me ask you that. That's a better question. What's the key thing?
This volume analysis. I mean, this is the confusion that always got me in trouble was trend versus fade. And if I happened to pick the right way and I got, and I'll say lucky, because at that point it was luck. If I got lucky and picked the right side, well, it was a great day. And if I didn't, then I was in trouble.
Yeah.
And so I think this is the differentiator that's let me decide, pick a side.
Yeah,
Yeah,
I'm gonna fade.
trend or fade.
And
And after that, it gets easier.
well, and the thing to notice is that he doesn't mean the trend of the whole day or for a week or for a few hours, right? Just the micro moments of a market. Is it going to continue up or is it going to break back down to where it came from?
Right.
Right? That's fair to say. It's just those micro trends. Um, is it going to keep rallying like this sequence, or is this rally just expensive? And if you're always playing the trend, then this sequence here would have worked. But maybe there's additional volume analysis that said, make sure you don't fade this because,
Yeah, that's
right,
exactly right. It's don't fade that. And that's what the volume analysis is giving you.
there's more. It's not cheap just because it's not rather it's not expensive just because it's higher.
That's correct. And if volume's building, that means people are happy with where it's going, and there'll be more coming in behind you. And if
Yeah.
volume's fading, then you don't have help.
But what's interesting is its volume relative to something unique, and not really unique, but something that makes sense why you would compare it to it. Because it's not just 15 minutes over the last day or a couple hours, and not just from yesterday's 11-11-15, but a 20-day moving average. So you got some hard, nice data where you're not overanalyzing it. You would want to see volume spike with price in this sequence, right? In order to go with it.
No, it's not. It's no. I wouldn't really care. I wouldn't look at it at that level. I'm looking for at that point. It's already faded up. It's not faded. It's already popped out of that hole, and it's consolidated. And so at that point, I'm looking at sell delta. I want to see the shot of sell delta. And you'll notice if you look at the last PNF bar, there's not that much volume in there. And
Right.
so if it had looked like the second bar where you've got 102 by 76, 121 by
Right.
77, you got some decent volume in there, and it had broken maybe a tick or two or three more. Well, then I'm all for it. But it just didn't do it. It didn't trigger me to the stuff that gets me in. It didn't do it.
You want to see negative delta.
Yeah, I want to see sellers trying to push it down and getting stuck, and or a combination. Well, you see sell delta coming out of there's going to be two things. It's going to be late longs puking it, and shorts trying to push it down.
Right.
And I want to see both of those guys get screwed.
Well, and right, the definition of a head fake,
Yeah, exactly.
longs get cleared out, so there's less sellers first to move up, and then shorts, momentum shorts getting stuck short, so they're buyers to help push it up, and they're pushing it up into less sellers, which makes it easier to do what? To go up. But what makes you, here's a question, what makes you go from, all right, you see it rally from here to here. Are you looking to fade this rally at all for it to go back down?
Potentially depends on what it does. Let's see what time that's 9:47. Let me see what it did then. Well, I mean, if you look at that time frame, it's an interesting price actually. The around the 11s. Oh, okay, I see where this happened. No, I'm done fading it by then because it had around the 11s, which is the top of the consolidation to the left. That was the regular trading hours, the day midpoint. It was the day VWAP. Just above it at 14 was the Globex VWAP. Once it pushed through all that stuff, it was time to stop fading it.
So you would have just looked to play it from the long side in this sequence.
Yes.
But you needed that negative delta to come in here so you could see this coming a little easier.
Yeah, so you can see you see the guys getting stuck. And when you pushed into that, you'd also push into, if you did what I needed, you'd have pushed into close to the top of the VWAP, the day VWAP, close to the day mid, all that stuff. So it would have done, had it happened, it would have tripped a lot of, checked a lot of boxes.
See, that's the key is you know the boxes that need to be checked and for your setup, just like everyone needs to know what your checklist is for your setup. So there's no ambiguity creates frustration because it's just very anxious. It's a very anxious moment if you don't know. Your setup could be crap, but you should be able to recognize it better than anybody else. I could recognize that crap better than anybody else. That's my crap.
When you do this, you got to figure it out fast, because when I'm doing the entries that really work, you've got between 1 and 3 seconds to push the button, maybe 5, but say on average you've got 2 or 3 seconds to decide and push the button. And if you miss it, it's done.
It sounds like my 40-yard dash.
There you go.
Between 3 and 5 seconds.
But that's all you got.
That's good though. So
you got to decide.
It's even more imperative you recognize your setup quick, because if you don't, it's gone. And most people are late to their setup because they don't have the recognition skills and understanding it.
Well, I think that's the other thing that's, what turns the corner. So you start looking at it at a 1 second chart level. How many guys are looking at a 1 second chart?
Not many.
Not many. And so guess what? I'm seeing a lot of stuff that nobody else is looking at.
It's like you being at the bar, you're seeing some females nobody else could see, so there's less competition.
Exactly.
Back when you were single, of course.
That's right.
That was my problem back then.
You're at the bar too much?
So 1 second chart.
So go back to the right, go to the right edge and look at where we are now. I remember we traded down into this, and I was telling you it's just going to wander around based on the volume. Guess what? Look what it's done. It's just.
Oh yeah, to now.
Yeah, all the way. Yeah, go to current. And so you look at that and go, that's just, there's not enough there to make the risk. If you're wrong, you're down 6 ticks a contract. If you're right, you're not going to get much out of it. It's just not worth it.
No, it's choppy. It's sloppy. It's choppy. It's just the needy and the greedy are participating in this time frame right now. But you're able to see it before. You're able to make a good, accurate assumption. It's too much risk.
Yeah, too much risk. So instead of being on the edge of my chair hoping something exciting is going to happen, I can either go get lunch or just lean back and watch and see what happens. But until this picture gets better, it's not trading, not for me.
It's great risk management. It's the trades you stay out of that help you turn the corner. It's the markets you stay out of.
And you're exactly right. That's been the difference for me, is staying out of stuff, because I had lots of great trades, but then I gave lots of stuff back by trying to do some more. You have a great trade and you go, oh, that was great, let me go do another one of those. Well, now you look at what's going on in the volume and you go, well, that was a great trade, now let's wait for something else to develop, because there's nothing here right now.
Yeah. Well, you're not letting that dictate. You're letting the market talk to you instead of your previous trade talk to you.
Mm-hmm. That's right.
Paul asks, what is Dave's bracket for trades? I think, what does that mean, Paul, for like his risk reward? The one thing that I'm trying to clear up is, again, you thought it was going to be like it is because the volume is way down for this period over the last 20 days. Correct?
Correct.
So that keeps
for the day and for the period. We're minus 38, almost 39% for the day. We're minus 57% on the 15 minute. There's nothing going on.
It's getting bad to worse volume wise.
Yeah, yeah, it just sucks. That's a technical analysis term. It just sucks.
But the one thing I'm trying to drill down on, and I don't want to dull the bit, so to speak, but I'm thinking you don't look at the market rallies here. If you're looking at my screen, you
I
don't
am.
care if on your 15-minute chart, if the volume spiked, meaning compared to the last 20 days in this period, how's it doing? You're not looking at that?
I am a little bit. So in that one bar, it's probably not that big a deal. But so I'm looking at over a series of 3 or 4 bars. If you see volume growing as it's going up, that's a good thing. That's, if it sits there and the volume starts to grow and, people are getting more interested in it, yeah, that's a good thing. But it's not as fast as that probably was. Let me see the times there. Yeah, actually, it might have, because that's what, 9:47 to 10. Yeah, so that's enough for several bars to come out. So yeah, it actually would have made a difference if I'm seeing that grow. If we're in a trend market, and we're not, but if we're in a trend market today and we're doing what we're going through that consolidation and I'm seeing volume grow, it's going to make me more interested in buying it, maybe buying the breakout.
Yeah.
Because it's sitting there banging around and it's growing volume. Well, the chances of it continuing on when it's growing volume are really good, but that's a trend market. That's not a fade market. So if I saw that with growing volume on a trend market, I'd want to be buying it. And I'd probably buy it when you push down that last one. I'd probably wind up buying it, 3 or 4 ticks from the high. It wouldn't be a great entry, but somewhere in there.
Yeah. Well, here, the reason why I asked this is because while it's not a trend day, it is a move, right? So it's a trend move. Let's not say a trend move, but it's a move, right? It's a move up right there. So in the flag, which is in here, as the flag is waving, is volume increasing? And if the answer is yes, you should be more apt to go with it. And go with it
Correct.
means buy it, because with it
Right.
means with this move up in the flag. So when you say you're seeing volumes good, that means compared to this 15-minute period on the 20-day moving average?
Correct. And I'm looking at it. I actually am looking at where exactly this happened, and volume was falling. When we pushed into that, when we initially pushed into the first push that took us to 16,
All right, that's
that
here.
bar was essentially 0. So it was 20-day average. But then it went down and down and down and down and down and down. In fact, it continued to go down in volume until we got to the far right just before it popped up. So it was looking like they weren't interested in it, because the volume was just falling. So the interpretation there is, well, all right, so if it's a fade deal, yeah, they don't want to sell it anymore. It was a tough read. That was not an easy read right there. But yeah, because it built volume going into that pop. So the thing prior, it was building volume.
Wait.
And that
it built volume in here or built volume in here?
It built volume on the box on the left.
Okay. I see. And when you say, again, built volume compared to, 930 to 945 on the 20-day moving average.
Correct.
Okay.
Yep, that's correct.
Volume last time it was down here.
But I'm less inclined to pay attention to that from a trend perspective, because the day volume is so low.
Right.
At that point, the day volume was minus, what's about where we are now, minus 38%.
See, that's like the I like that. I mean, what I'm saying is that what you give less credence to what the 15-minute volume is doing if the overall volume is down, because that creates a non-trend. So if you got a big
Correct.
move, chances of getting another move and another move, another move are just going to be less, given the context of the daily volume is still down a lot. So the 15-minute volume you'd be less sensitive to.
Correct.
For instance, if your daily volume was better than average, so you had better daily volume, then when you went lower into this move and the volume picked up during this time period, you'd be more inclined to think that it's going to follow through.
Correct. That's exactly right. So I'd be looking for it to pop out. In fact, I'd look for a pop to 11, 11 half, something to fade, a head fake to fade. And if I wasn't getting that, I'd probably chase it a little bit and shoot it down, especially if it was the first big bar down. So big bar down, consolidation, even without the head fake. If volume's build, then it's time to say continuation.
So Tom asks a good question. I don't know if I understand it. Let me shoot it at you. What about differentiated volume? To get volume change acceleration, any value or?
There might be. So remember that I'm doing really that I've been looking at this for, I don't know, 6 weeks, maybe 2 months. And so it's probably 6 weeks. And so I'm learning new stuff about it every day, and I'm doing really detailed analysis on my performance versus it. So there may be some value that I just haven't found yet. So this is a work in progress.
But this is something that I think stripped a ton of randomness out.
It does.
For you.
And since you've never heard of it before, I'm pretty sure there's not very many people looking at it.
Well, I haven't heard of anything. I've never claimed to know everything. That's what makes me smart. I'm smart enough to know.
But if it was in common use, you would have heard of people doing this stuff before, and as others would have heard. I mean, Peter Davies does one that's. In fact, I stole part of this idea from him, but he's looking at it in a completely different way. So,
that's the whole point of collaboration is, slivers and things that might work for someone could work totally different, but it's like the same but opposite. And it's funny to say it that way, but that's the intricacies that you pull together and say, oh, I got it. That does one thing, strips out randomness. You come to that moment of clarity that now how to bend pipe. Like when I was doing electrical work, I couldn't understand how to bend pipe. And then one day something happened, something was done, said, and I could bend pipe. And you think, well, what's so hard about that? It's really hard when you're trying to do it. And then it's the definition of understanding is when something becomes less random.
Well, and credit where credit is due. The idea of the 15-minute thing came from Tom. We observed one day that, hey, if you're not seeing volume on a bar that's above a certain level, it's not going to go. It's not going to, because I was already looking at the 20-day average, and he made that comment, and that was probably, I don't know if it was last week before. That's recent, and so I took that idea and turned it into the 15-minute look back, which is just so the idea I stole from Tom, or he volunteered it, but it's little pieces of stuff that you put together and you put it on the screen and say, does it work or does it not? Because there's some other stuff that I've tried that just didn't work, looking at sums of deltas and all that, which sometimes shows you some interesting things, but it's really noisy. But this deal with a 15-minute volume that based on that suggestion is really useful.
I didn't say lay pipe. I said bend pipe. Did I say lay pipe?
No, you did not.
I said bend pipe. People say, what does that mean?
You know where their minds are.
They misheard, they said. Well, two separate guys said it. I said, well, maybe I misspoke. When I did electric,
I didn't hear it that. If you said it, I didn't hear it that way. So we know where my mind is.
Yeah. Well, bending pipe. Although you do lay pipe in trenches and stuff and things like that. But anyhow, understanding comes from stripping out randomness. The other cool thing is that trading. Hold on, I dropped something. Trading and the whole unity that we have here is like it's a living, breathing thing. You know, you'll get something from someone that spiked your performance, and they might not even have realized that they told you something that was really helpful. Like Tom, you're talking about Tom K.
Yes.
From Boston.
Yes.
Yeah, that's good. And he turned you on to the 15-minute.
No, his idea was he just observed that if you don't have good volume in a bar, that you're not going to have good movement, a good continuation. And so then I contemplated. I actually tried a few different windows. Tried shorter windows. I tried a 5-minute window. I tried various things out to 30 minutes, and 15 seemed to be the best.
So you're constantly qualifying and disqualifying your setup.
Yes.
Oh, that's good stuff. Well, we'll as we move forward through the end of the year, keep circling back to some of it. But thanks for sharing, Dave. This was a good meeting.
Hey, you're welcome.
All right. I'll turn Dave off for a second. I actually didn't plan on this meeting being that, but with some of the things he said yesterday, it just gave me an idea that this would be a good thing to talk about. So again, other people are here in the chat window are thanking you for sharing. But I can't emphasize enough, if you're bored, don't trade. If the lack of volatility has you bored, will quickly overanalyze and find and see something that's not there, and you're no longer trading any kind of skill, but you're just trading because your mind, you can't force your mind to find it. Once you've built a skill set, you either should see it or you don't. And just summarizing a little bit of what Dave said. That's why I kept asking. He could recognize what he's looking for. And what he has is working for him. But if he had something that wasn't working for him, it's still important to be the one that best recognizes it. If you can't recognize it, you're not going to be able to trade it. Next week I'll show you how to bend some pipe. 90s offsets. Nobody in here is an electrician, are they? We always had plumbers and carpenters, no electricians. I'll stop the recording for those watching in the future. The session is